Okay, now we can continue after this power cut. Now, again, if you consider about the highlights, now as per this best annual report, then it is given that revenue, profit before taxation, earning per share, dividend per share, as I told earlier. Then investors consider about the uh, capital gain as well as then dividend gain or the dividend yield. Therefore, they always concern about the earning per share and dividend per share. These two are very much important information. Sorry. Then market value per share, another one also, another important one to determine the capital gain. Then price differences. Then investors can make decision based on the price differences and trend of that market price per share. Then these are very much important information given by the annual reports. Then uh, in normal conditions we can see these details on the face of financial statement, but here it is given the given as the highlighted information. Then investors and the users and readers of the financial statement and the annual reports directly identify their important details. And in addition to that, this is given their product and nature of product, their variations and diversification, all they can understand through this type of pictures and attractive details, right? Then again, users of this annual report, they are luckily to identify their products and nature of the business through this type of additional details. And sometime they may have some CSR project and their details all are given by this type of annual reports. Then this attractiveness is the key one of the key factor for determining as best financial statement and also the content of this detail. Then operational performance, now you can see performance highlights also given during the now I think you have remembered that comparative financial statement. Now this is the analysis, the financial statement analysis. It is given that operational performance, revenue previous year 2617 something, but in this year it is exceeding that 3030, right? Then we can see approximately 16% improvement of this results revenue. Then results from operating activities, they given again, we can see positive improvement or the positive changes, 26%. Profit before taxation previous year 331,000. Then this year 433,000. All are given in thousand, right? Then again we can see 31% improvement. 31% improvement in this profit before taxation. Profit after taxation, again 28% improvement. Previous year 261,000 something, then this year 334,000. If you move to the dividend paid during the year, you can see previous year total dividend payment is 127,500. Now this year 180,500. Then 280,500. This is approximately 120,000 change, positive change here. Then earning per share previous time 10 rupees and 25 cents per share. Now this year 13.13 per share. Then again 28% improvement. Then cash earning per share previous time 17 rupees. Then here this time 20. Then again 21% improvement. Interest coverage also, number of time previously 17 approximately, now this time 32. Then again 84%, 84 percent improvement. Then return on capital gain. Return on capital gain, previous time approximately 18, now this time approximately 22%. Again, you can see that improvement, right? Then return on equity, return on ROE also increased by 20%. Now this time, this type of highlights and this type of information, those are very much important for our stakeholders, not only investors, then prospective investors, then creditors, then management and bank and financial institution, government agencies. They are always concerned about these details. If you think about the important line items in the balance sheet or the statement of financial position, total assets previous year 2318, now this year we can see 2412. Then very small improvement here, change here, positive change. But total debt, if you think about the previous year and this year, you can see total debt decreased by approximately 80,000, no? Then 32%. Then shareholders funds increased by 4%. Number of shares in issues remain the same. Then net assets per share, this is also very much important ratio. Net asset per share, or sometime we are calculating book value per share, right? This net assets per share is 66 previously, now increased by 4%, approximately 4%, 69 this time. Then debt equity ratio, another important ratio for deciding the capital structure and the financial structure. Then debt equity ratio previously 12.5, that means in this year decreased by just 35%. That means low debt capital. Therefore, then again it may affect to that interest coverage too, right? Debt to total assets previously 9.17, now debt to total assets 5.98, again decrease that financial risk or the debt amount. Then quick asset ratio, that is directly relating to that liquidity position, now previously 1.99, now 2.3. Then again we can see good improvement of that liquidity position. Then decrease that debt equity, the debt capital, and debt payment also there. But even under that conditions, then quick assets or the liquidity position also increase, right? Then again net revenue and gross profit, then gross profit and net profit. Now you can see that comparison, very attractive graph, bar chart and line chart. Then you can see that type of attractive document. Those are very much important for making decision for investors. They are attracting this information. Then market price per share as at 31st March. Then you can see that additional details, market capitalization, enterprise value, price earning ratio, another important ratio for investors. Then as per the 2015 10 point something, then 2016 13, that in that point of view price earning ratio is not so good. What is the reason? Now this idea behind this, if it is 10 mean, yes, we have to wait 10 years for covering our initial investment in that share. But in the year 2016, yes, as per the year 2016 prices and the earning per share, then our value is approximately 13 times. We have to wait 13 years to cover the market price per share. Then I think it may be the reason for increase in share prices, no? Share prices. Then dividend payout, previously 48%, now 83%. Dividend per share, previously 5, now 11 rupees. Dividend yield also increased. Then economic value added, another important variable or the detail or the measurement is economic value added. Nowadays we are using this concept. This is a good concept rather than that cash flow or the earning. This is the good concept. Here we are considering that economic value added also. Then you can see again 16% improvement in that EVA. Then employee benefits liability as at 31st March here 2016 and 2015, you can see 16% improvement. Community service and infrastructure projects, now CSR project, again we can see improvement by 35%. Proportion of purchases from suppliers within Sri Lanka, again we can see that additional details. Then again attractive product varieties and product details and pictures here. Then those are important for the information seekers. Then yes, you can see there's additional details, and also there are some strategies also, and corporate governance details also given. And in addition to that, number of independent directors, number of non-independent directors, all are given by the financial statement. Here you can see independent directors, audit committee, employee participation, internal control. Then you can see additional details, right? Those are very much important to measure about the corporate governance and good governance of that organization. Then corporate governance details, regulatory framework, those regulations and act, and internal governance then structure and methodology, it is given. Then board composition. Now these are very much important when you are doing your research, right? In some interesting to do research in this area, corporate governance, good governance, corporate governance. Then non-executive directors, independent directors, non-independent directors, board composition. Those are very much important variable in that way. Then here in additional details regarding this corporate governance. Here I'm not discussing all those things, but we need to know what are the important criteria in this type of attractive and best financial statement. Yes, board meeting and the details, regulatory of meeting, and date of board meeting. Now you can see that details, their participation, whether they are present in or absent, all details here. Director responsibilities, compensation for early board evaluations. Now you can see additional details, again corporate governance details, board inductions and training. Those are the details under this financial statement, right? Again corporate governance details. Yeah, there are a number of pages on this matter, corporate governance. Here performance management system. Here you can see clear picture on that performance management and governance. internal equity, then stakeholder management. Yeah, stakeholder management and all details here. Stakeholders or the investors, customers and suppliers, shareholders under the stakeholder category. You can see shareholders and investors, prospective investors, customer and suppliers, government and government agencies, key stakeholders and employees or the workers. Then how to join them to the management and manage the business. Then here, this is the organization structure. Then chairman, board of directors, directors, and other details here. Here, governance framework also given, right? Yes, there are a number of pages allocated. Pages are allocated for explaining good governance, governance details, right? Corporate governance details. Again, good governance. You can clearly understand how far uh, they are paying attention on this good governance and corporate governance. Yes, enterprise risk management. Yeah, sustainable risk management. It is also given details on this matter. Then macroeconomic environment and changes in interest rate, changes in uh, exchange rate and tax and tariff. All macro level information is also given for making decisions, and those are very much important to manage risk level in the future. Then all are discussed under this annual reports, and also they are giving their strategies, value creation model, and then investors mainly concerned about their value of the business and value creations, and then all are given by this type of annual reports, right? Then when they are evaluating, especially then CS Sri Lanka, then they are concerning about the corporate governance and then this type of disclosure quality and integrated reporting, all are very much important to determine that best annual reports in that area. Productions, the manufacturing companies, and also business review, the social and relationship capital. Now that is the new concept here, social and now the new word they are using, social and relationship capital, social capital. Then you can see number of concepts here. I skip this type of additional slides. Now we can go to the value of employees and their specific features also here. Here this is the detail employee categories here, also here number of employees and their composition. Their services, global reporting, yes, here global reporting initiative index and other details. board of directors and their details. They are planning and also the audit committee reports and opinions. Statement of director responsibility, independent audit report and their opinion here. Opinion. Here, now you can see after 94 pages, now you can see the annual report. That means financial statement, right? Income statement, group or the group or consolidated and the company during last 2 years differences. You can identify through by comparing these two figures. In annual report, statement of income statement and statement of financial position or the balance sheet, and statement of cash flows. Again, you can see activities under different categories: operating, investment, and finance category, and statement of changes in equity. This also given. And finally, that final mean under the financial statement, it is given notes to the accounts and important policies, accounting policies. Uh, you can see that details 94 to then how many pages are allocated for financial statements out of 164 pages of this annual report. Then you can clearly understand the weight of the financial statement of this annual report. Now 94 to 114, just 16, approximately 20 or 30 pages out of 164, less than 50%, right? You can see that's details, shareholders details and dividend details here. Then clearly you can understand what are the key component of this annual report. Not only the financial statement, right? Not only the financial statement, then you can see that details, then financial highlights and governance details, corporate governance details, and strategies and risk management policies. They all are given under this financial statement. Right. I think it is very much clear. This is regarding that manufacturing organization. In addition to that, there are a number of highlights here. Financial highlights here. 10-year information. Information at a glance. You can see that details here. Profit from operating activities, net financial income, finance income, profit before taxation, income or expenses, and also net profit after taxation. Then assets base, property, plant and equipment, non-current assets, short-term investment, inventories, and other trade debtors and receivables. Then stated capital, reserve, then total equity, non-current liabilities, and current liabilities. All are given for 2000 here 2007 to 16. There are 10 years details, right? Here key figures and ratios also given. No need to calculate actually. I think if you select this type of company to uh, calculate or analyze that data, most probably you can take these details from financial summary and the key indicators, key indexes, right? Then you can see net when you have, I think you already calculated and interpret that ratios and other compared to financial statement under the assignment. You already submitted, no? Submitted that assignment. Then here, then net profit ratio, at that time you calculated net profit ratio, earning per share, return on equity, return on capital employed, dividend per share, debt equity ratio, shareholders equity, current ratios, quick ratios, interest coverage, price earning ratios. Then those are very much important ratios. All ratios given for 10 years again. Then directly anyone can compare and they can use these details to make decision. Right, those are the important details given by this annual report. Further we can go for the additional, yes, another annual report. This is from again John Keel's hotels. It also won the best annual report awards, gold medal for hotel sector. Now again you can see how attract these financial statements. You can see very attractive pictures and details. Then quality of their services also we can add. Then relevant parties can understand. Yes. Then in addition to that, now you can see that similar type of details here, performance scorecard here, then clear picture about the hotel. Our yes, you can see hotel portfolios, group structure, key achievement in year 2015-16, and their facilities, and here again financial and operational highlights also given as the previous one. Now you can see revenue, earning per share, the same structure because same group, right? You can see revenue, earning before interest and taxation, profit before taxation, profit after taxation, profit attributable to shareholders, earning per share growth, interest coverage, return on equity, pre-tax return on capital employed, right? There are number of total assets, total debt, total shareholders fund, number of shares in issues, number of shares in issue, net assets per share, debt equity ratio, total debt to total assets, market price per share, market capitalization, price earning ratio, right? Then here you can see some improvement. Previously 11 point something, 11 times, now 10 times. Then operating cost, employee wages and benefit. Now you can see other expenses also, important expenses for making decision, especially for that union and other labor union and other uh, employees. Yeah, this is yes. If you think about that, then main category was one main category was that highlights. Now next one, chairman's message, right? Chairman message. Then you can see chairman message. You can highlight it. Then you can, based on that you can provide answers, right? Then as per the previous question, then we can think that is the chairman message. Here board of directors and their details, and their independence and governance details, corporate governance here, again corporate governance. Yeah, here again clear picture on this corporate governance system of this John Keel's hotel PLC. Here again you can see majority of that pages are allocated for corporate governance, and in some organization they allocate in number of pages for CSR and other attractive pictures. Then audit committee report and audit independent audit report, risk management report, that is also one part of that. Then audit direct, yes, here risk management report, and yeah, audit committee report and independent audit opinion also, risk management report. uh, Again you can see number of pages on that matter, risk management. Then management discussion and analysis, management discussion and analysis. Then sustainability report here, business performance. Now again you can see attractive graph and chart to show that details. Again business performance details here. Then manufactured yes, capital and their strategies and new projects. Then merge and acquisition details, all are given by this type of annual report. Again you can see attractive pictures. And then value creation report and economic value added, and other details regarding their diversity and their brands, diversity of that product. CSR activities value creation report again. Now out of 264, yes, now we already completed 140 pages, right? Now up to plus 140 we don't have that annual reports, financial reports, right? Financial statements. Yeah, yeah. This is GRI contents regarding that integrated reporting. Yeah, independent assurance report, audit report. Then investors information. Yeah, details and their composition percentages are given. Independent audit report. Now you can see income statement after 166, right? Comprehensive financial statement, income statement, statement of financial position, uh, right? These are the details, cash flow statement, and notes to the accounts. Notes to the financial statement. Right. Now I think you have clear idea about this annual reports. Then if you move to that book and commercial bank financial statement, right? Again you can see different categories. Again, what are the categories here? Management discussion and analysis, sustainability reporting, stewardship, then you can see financial reports, supplementary information. Then clearly you can understand that composition of the financial annual reports, not only the financial statement, but also you can see that additional details, right? Then, as I told earlier, again, I need to take this time, this opportunity to explain about this book. This is Subramaniam, K.R. Subramaniam, and John Wilde. This is a good book. Good book. In this case, I have hard copy, but soft copy also here. But this was published in 2010 or 9, right? But similar details here, similar details, right? Now you can refer this book. It has 787 pages. Yes, you can see that details, overall financial statement, financial reporting and analysis, analyzing financial activities, investing activities, and here cash flows analysis, return on investment capital, prospective analysis, credit analysis. I think you already discussed that credit analysis and financial distress and sets Allman reset model and financial distress computations and credit rating also, no? Credit rating, all details given by this. Then you can select relevant topic and you can refer this book. Again, if we move to these questions, again, yes, discuss these quantitative and qualitative informations are useful in investors' point of view. Now, this is regarding the annual reports. Now, I think you have clear idea about the component of the annual reports and then what are the details, quantitative and qualitative details given by this type of annual reports, right? I think you can write this type of just provide answers for this type of questions by analyzing that type of annual reports. Based on the best annual report, clearly you can identify that key component of the financial statement. That's why I already uploaded that best annual reports into your LMS, right? Then state component of complete set of financial statement and explain key objectives of each component. Previous time also, under the previous question also asked the same type of questions and we discussed them. Then next one, briefly describe the limitations of financial statement which are published by the financial companies. Then here again, these are the information, financial statement, management decisions, and this is under the annual report. Management decisions and analysis, management reports, audit report, independent audit report, audit committee report, explanatory notes, supplementary information, social responsibility reporting, corporate responsibility reporting, or the corporate governance. There are a number of items. I put here a few things only. Then these are the key financial statement. Then you can see some details regarding that financial statements, financial position, what is the financial position of the firm at a given point in time, point of time. How is the financial performance of the firms over a given period of time? Then it is given by the income statement. This is given by the statement of financial position, previous one, right? Then you can see some details about the comprehensive financial statement, cash flow statement, and their role. Now this is yes, this is relevant to the previous question. We asked the questions about the qualitative characteristics of financial statement or the account information, right? Then limitations of financial statements and financial statement analysis. Actually, then limitation of financial statement analysis directly depends on the limitations of the financial statement. We are going to analyze details in the financial statements. If there are some issues, then again we have to have some limitations of that analysis, right? Then it is difficult to use that type of results of the analysis. Results for making decision, then it is far from the reality. Influences of personal judgment. Now you can see that details. Influence of personal judgment lead to opportunities for manipulation while preparing a financial statement. Are you aware with this issue? Information disclosed by financial statements based on accounting concept and conventions. It is unrealistic due to difference in terms and conditions and changes in economic situation. Then financial statements are normally prepared on the basis of accounting principle, convention, past experience, and therefore they do not communicate much about the profitability, solvency, and stability and liquidity of the undertakers to the users of a statement. Then financial statement emphasize to disclose only monetary facts, qualitative facts. They are not going to provide qualitative information. Financial statements disclose only the historical information. It does not consider about the forecasting or future information, right? Then again you can use that type of information to provide answers for the for that question. Those are not real answer for that questions, right? Again I need to say about that, otherwise then others may think now those are the answers for that questions, right? Just I selected some slides to put here to get some information, right? Then question 3, different analytical tools can be used to analyze the financial statement of different organizations. Describe each financial statement analytical tools with the with each with their inherent merits and demerits. What are the advantages and disadvantages of each and every financial statement analytical tools? And next, asking about the ratios, provide information about the company's performance and best used to measure the companies against other firms in the same industry, and to denote trends within the company. Now, as you all know, then if you know that ratios and financial details, then you can compare with the same organization with the previous or the historical data, historical ratios, and also you can compare with the competitors, and also you can compare with the industry norms. uh, then these are the relevant details. Now, what are the financial statement analytical tools here? I got these slides from the previous lessons here. Horizontal analysis and vertical analysis and ratio and cash flow analysis. Now, there are a number of analysis. One way of presenting that analytical tool here. Another way also here: horizontal analysis, vertical analysis, ratio analysis. Again, you can see trend analysis, comparative analysis. Under the vertical, you can see common size financial statement analysis. Here, ratio analysis. There are a number of ratios and number of major categories under that ratio analysis. Right. Now, this is here. This concept also very much important when you are comparing that ratios or other financial details. Now we can consider two concepts. One is intra-firm comparison. Another concept is inter-firm comparison. Intra-firm mean within the organization we can compare with the historical data or the within the same financial statement we can compare and we can prepare that analysis. But intercompany mean in between two or more organizations we can compare that results or the ratios or other details. Now, if you see this chart again, I think you have remember these slides again. I got from the previous lectures. Then you can see intra company within the within year 2012, 13, 14, 15 we can compare. That is the intra company. Then intercompany, then we can compare company XYZ with company A with the company B likewise, right? Then that is called intercompany comparison. I think you have clear idea about this. Then this concept is very much important, and clearly you have to identify that analysis. Next, if you move to the industry average, industry norms, you can compare industry norms, then company averages with the industry norms or industry averages. Then this is the way of getting the industry average. If you have only three, if you assume that you have only three organizations in this industry, then we have to take the average of these three. Then A plus B plus C divided by 3. Then you can take the industry norm or the industry average. Then you can compare with the company. Then if you move to the ratio analysis, there are a number of ratios, there are a number of categorization, but generally we are accepting this analysis. Then profitability ratios, liquidity ratios, then financial stability or the leverage ratios or the activity ratios or the turnover ratios, and market ratio or the investors ratios. These are the categorization here. Then liquidity ratios, profitability ratios, financial structure ratios, asset management ratios, investors or market ratios. As I told earlier at the beginning, then I am not going to discuss new things here. Now again and again we are talking about the previously discussed matters, right? I think you have remember that. This is the recap session. Now, if we move to the liquidity ratio, Then there are a number of liquidity ratios. I am not going to discuss in detail. Current ratio, acid test or quick ratio, super quick ratio or the cash ratio or defensive interval ratios, net working capital ratios. There are a number of liquidity ratios here. Then you should have clear idea after calculating how to calculate these ratios. Then within the final paper, I hope to check your knowledge on this calculation of these ratios, and also how to interpret that result. That is the most important one. After calculating, or the if you refer that previous financial statement or the annual report, you can see that important ratios, net asset per share, earning per share, price earning ratio, debt to total assets, debt to equity. Then there are a number of the return on asset, return on equity. There are a number of ratios. Then you should be able to interpret that results, and you should be able to interpret mean you can use that details to make decision, right? That is the most important one. Not only this calculation part, then you have to have that uh, interpretation part, right? These are the profitability ratios. There are a number of profitability ratios. Profitability ratio based on sales, and profitability ratio based on investment, right? There are a number of ratios. Gross profit margin under the sales base ratio, operating profit margin, net profit margin. Then there are a number of ratios under that under the first category. Second category, investment basis based profitability ratio. You can see return on assets, then return on capital employed, return on net assets, or the return on equity. There are a number of profitability ratios. Then those are very much popular among investors and business decision makers and stock analysts. Right. Then third category, structure here, the capital structure or the gearing ratio, or the, otherwise we are using term leverage ratio. Then debt to total assets, debt to capital ratio, total capital ratio, or debt to equity ratio. These are very much important to determine the financial risk level of the organization, right? Then whether it is the levered company or the we can decide based on this results. Then if you take one example, debt equity ratio, if this value is 1, then that means debt equal to equity, right? Then if it is greater than that, then debt rate is greater than the equity ratio. Then we may have some issues in the financial risk. Then risk conditions may be there. Financial risk conditions may be there. Then assets management or the turnover ratios, so the activity ratios or the efficiency ratios, we are using other term efficiency ratios. Inventory turnover ratio, number of days sales in inventory or inventory resident period, or account receivable turnover. Again, number of days sales in receivables, accounts payable turnover, net assets to total assets, net sales to assets or the total assets, ratio of net sales to assets, net non-current assets to fixed assets turnover, and there are a number of additional then asset utilization ratios. All are using all are used for measuring that efficiency and the activity level or the efficiency level. This is the most important ratios for investors. Investors ratios, or the stock market ratio, so the market ratio. We can use different types of word in different books, and different authors use different uh, words, then terminology, then earnings per share. First, then earning per share. It is again a very much important measurement to determine the earning capabilities of that organization. Then most of the investors and prospective investors, they are seeking this type of details or information. Dividend per share. Again, it is also very much important. Then, as I told earlier, investors mainly concerned about the earning capacity as well as the dividend per share, and also price increment in the market price, that to determine that capital gain as well as dividend gain, dividend yield. Then book value per share or net asset per share, price earning ratio. Dividend price earning ratio, normally it is given by the times. Then if it is 6 time, that means we have to wait 6 years to cover today investment in this share. Dividend yield and dividend payout ratio. Then dividend payout also very much important indicator about the organization. If you think about this ratio, then then growing company, then it may have very less number of that less percentage for this ratio, but matured company, then that mean they don't have opportunity to expand the business, therefore they are not providing they are not providing dividend uh, much. Then we can see that type of difference also through this financial ratios. Uh, then again some criteria also here. Some criteria again, I extracted these details from the previous slides, right? Then again you can see this benchmark values, and if you think about that quick ratio or the other ratios, then if it is greater than a particular value, then we can make decision based on that. For example, if you think about the quick ratio or the quick ratio, if it is greater less than 1, that means we don't have enough short term finance or short term assets to assets for meeting financial short term liabilities, right? That is the indicator. Likewise, we can get this type of details to explain, right? Here I am not going to discuss in details. Then industry norm, how to compare that companies annual reports, sorry, companies ratios and other details with the industry. Now if you think about here, then this is again I got from the previous lectures sessions. Here ratios, current ratios from Toyota, Nissan, Ford and General Motors. Right now we can compare within these three four, and also if we have that industry average, then we can compare with the industry average. That is the major benefit from the ratio analysis. But if we think about other analysis, it is somewhat difficult to compare to company, but within the company we can compare. For example, if we take uh, compared to financial statement, then we can compare that changes as a percentage, but there are some issues too. But if you have common size financial statement, then you can compare that percentages with the comparative organizations. Here you can see current ratio 1.1, right? Even if you have this type of information, you should have clear idea about the ratio. Now 1.1 mean current ratio 1.1 mean we have only 1 rupee and 10 cents for meeting current liabilities. Then if you go to the quick ratio 0.98, to meet this 1 rupee of 1 rupee of current liability, we have only 98 cents. Then we have some liquidity issues. But in Nishan company, we can see current ratio is not so good, but as per the industry, that means as per the norm, we expect 1 to 2. Then if you have one, yes, if you have one liability, 1 rupee liability, then we should have two current assets to meet that current liability. That is the accepted norm. But in this case, we have in Nishan company, we have 1 rupee and 45 cents, but quick ratio is greater than 1 rupee. Sorry, greater than 1. If it is greater than 1 mean we have 1 rupee and 22 cents to cover 1 rupee of 1 rupee of current liabilities. Then we have good liquidity conditions when comparing with the Toyota. That means Nissan has the good conditions when comparing with the Toyota. Ford, if you go to the Ford, yes, it has good liquidity position 2.92, and quick ratio 2.75. Then at that time, that Ford company had 2 rupee and 75 cents to 2 rupee and 75 cents of current assets to meet their quick assets to meet their current liabilities. That is good liquidity conditions, but we should concern about the idle money. Sometimes there may be idle assets or idle money without investing in a proper way. That idle money not uh, earn any cents. That is the problem, right? Then again, we can see in liquidity position is good. We can say that liquidity position of Ford is good, but sometime we cannot see good that mean performance, operating performance. Then there may be some issues with that performance, but they may have that liquidity position. General Motors, again, we can see that liquidity problem 1.23 current ratio and quick ratio 0.94. Then you should be able to explain this type of table or the results after computing ratios, current ratios, quick ratios. Then you can prepare this type of table. In the same organization, you can prepare this type of table for year 2015, 16, 17 likewise. Then you can extract that details to this type of table and explain it, right? Then you can compare with the previous years, right? Here, if you have this type of details, then you can compare between organizations. Then here, this details also here. I am not going to discuss in detail. Here, current ratio is the ratio of the current assets and current liabilities. It shows if a company is able to meet its short-term obligations or not. As shown in the table, all the companies have the ratio over 1. That means they have enough current assets to settle their current liabilities. All the companies can trusted on their liquidity abilities, but having too much of current ratio suggested they have too much current assets that is left uninvested. Now that's why I told earlier. The extra assets are waste by the companies. For instance, Ford has the current ratio of 2.93, which is too high. Total has 1.10. Nissan and General Motors have 1.45 and 1.23 respectively. Now you can see that evaluation or the analysis or interpretations. Now it is very much important for explaining and making decisions, right? Here again, if you compare with the leverage or the capital structure ratios, total long-term debt to equity, then if it is less than less than 1, that means yes, equity capital is higher than that. This is a long-term debt to equity mean long-term debt over equity. Then if this value is 1 mean debt equal to equity or equity equal to debt. Then if this value greater than 1, that means debt greater than equity. That is not so good for that mean financial risk, uh, in terms of financial risk, right? Then here, if you think about these four organizations, all are having less than 1, 0.62, 0.72, right. Ford's, it has higher value, no, 6.62, 6.62. That means it may have that financial risk issue. Ford company, right? That is the major issue. In addition to that, all other companies are having good long-term debt to equity ratio. Then total debt to equity ratio also high in the Ford company. This 8.94, that is not so good. But all other companies 1.67, 2.27, 21, and 1.59. Then here again, if we have again, if we have very less number, 1.67 like this, then it also indicate now we have some that mean chance to or ability to increase our capital through debt capital, right? But if you think about Ford company, then they are exceeding that rate 8.94 or 6.62. Therefore, they cannot increase their profit, their capital from uh, debt capital again. Is it clear? Right now, again, you can see some details here. Long-term debt to equity refers to the ratio of the long-term debt and shareholders' equity. Total Toyota's ratios of 0.62 refers along with €1 of shareholders' equity. There is 0.62 euro of long-term debt in the company. Having a lower long-term debt to equity ratio means the company has not taken much loan or debt capital, which means that they will not have to pay interest to fill up the financial risk. Now again, it is also a good indicator about the financial risk, right? Then long-term debt to equity and also debt to equity, long-term debt to total capital. Right, now you can see that analysis and interpretation part. Then if we move to the profitability, there are a number of ratios. Among them, these are major ratios. Return on total assets, zero 0.01, very less or insignificant value here. Return on total assets is 0.01, 0.02 Nishan. Then Ford 0.11, somewhat greater. Then it has higher debt capital and also higher return on total assets, right? Then General Motors approximately 6% or the 0.06. It is not material, no? Then if you think about that mean in terms of profitability, it is not so good. Return on equity 0.04, 4%. Nissan for 13%. Here the Ford is 135% or something, right? Then General Motors 19%. Then as you all know, we have cost of capital. No, we know the term cost of capital, or you already calculated WACC or the weighted average cost of capital or marginal weighted uh, average cost of capital. Then when you are collecting money or the financing, then we have a just cost, no, cost of capital. Then we should invest in all assets or the all capital in a proper way, and we should earn from that capital. Otherwise, we cannot pay interest, right? Then we should have higher rate of return greater than cost of capital, right? Then otherwise we cannot earn profit. Then again we have to consider about that issue, right? Then turnover ratios, total assets turnover, account receivable turnover, inventory turnover. There are number of ratios: Toyota, Nissan, Ford, uh, and GM Motor, General Motors, right? And you can see that details, right? Interpretation part. Then average collection period, number of days very high in Toyota. Then this may affect to this liquidity also, no? Then 131 days. Then Nissan 141, here 130, 141, 210, right? Average collection period. Then here this one General Motors is good, 24, right? Then again we need to consider about this matter, right? Then this yes, 113 mean more than 3 months, no? Here more than 4 months, right? Then we have to consider this 210 mean yes, more than 6 or 6 7 no, approximately 7 months, right? Then again we have to consider this matter. Now we can, if you refer this one, account receivable turnover ratio is a very important ratio, as the ratio divided by 365 days of the year of a year gives the average collection period for the company. As per the previous table, it shows that the average collection period for the four companies, General Motors collect cash from the sales in just 24 days, while Ford needs 210.4 days in average to collect its receivables. As there is no productivity of account receivables, it is better to get them collected as soon as possible and reinvest the collected assets into the business. Actually, now these are the real data, right? We don't know, I don't know what is the reason for this type of higher average collection period in our business. Actually, it is difficult to maintain this type of higher average collection period without that mean collapse in the business, no? Right? Then it is difficult to manage, right? Then we have to concern about that. Then when you are writing them, then if you are given that type of table, you should be able to interpret that results and compare that results. What are the pros and cons and advantages and disadvantages of that ratios? You can think in different way, right? And you can provide answers. Then you can see some additional details. Now again you can see summary of that details, summarized details here. Current ratios, quick ratios, they again previous details, right? Take into the same table, right? Then again we can see some discussion. You can refer them to understand, right? Discuss the importance of financial analysis for different stakeholders and broad area of financial analysis. Previously also we saw the same type of similar type of questions. Annual reports of public limited companies are providing both accounting and non-accounting informations which are important for business and economic decision. Discuss about the informations which are presented in annual reports and state how these accounting and non-accounting informations are useful for the internal management, investors and creditors. Now you have to think with these three categories, three stakeholders Based on that, you can provide the answer how far they are using and they are that means useful accounting and non-accounting information, right? Then next one, based on the credit analysis, you are given based on the, yes, last time this credit analysis was done by Mr. Saman Bandar. I think you have clear idea about it. Credit analysis is the evaluation of a firm from perspective of shareholders or potential shareholders of holders of its debt, not shareholder, holders of debt, including trade payable, loans, and public debt securities. Comments. Now you have to discuss this matter and content of this uh, potential and prospective debt details, right? Credit analysis is involved in a wide variety of decision contexts. Explain about the uses of credit analysis with the relevant reasons for using credit analysis. Then importance of credit analysis or the usefulness you can explain through this way. Then briefly explain the following: the credit analysis process. You know that the credit analysis process and credit rating agencies. There are a number of credit rating agencies, right? Whether we can show that slides. Uh, then Altman here, Altman here, spelling mistake here, Altman models, corporate failure prediction model. Then you can explain how far you can use this Altman corporate failures prediction model or the financial distress model to make decisions, right? Then if you go to, yes, the fifth question of the previous paper, you can see that financial statements, income statement, comprehensive income statement, and here statement of financial position, right? Then asking about some questions. Using the above comparative financial statement, you are required to answer the following question. Prepare common size in financial statement, that means income statement and balance sheet. Just then for year 2013 and 14. Then you should be able to prepare that common size financial statement. If it is important to know when you are preparing that common size financial statement, then under the uh, income statement line items, all are converted into the percentage based on the sales. Then if you move to the balance sheet or the statement of financial position, then you can convert all the real value into percentage based on the total assets, right? Then you can see percentages and you can compare 2 years or two organizations. Then and also you can interpret that results, what are the important progress or the improvement or the some that mean adverse or favorable uh, trend you can interpret through the common size ratios. Then second one, compute the ratio relevant to the following categories and discuss the progress of the company from investors perspective. Liquidity ratio, solvency ratio, profitability ratio, activity ratios, and market or investors ratio. Here very much important to know, here we are asking broader that mean we are asking ratios, liquidity ratios in broader sense, right? Then there are a number of liquidity ratios we discuss: quick ratio, current ratio, quick asset ratio. If it is possible to calculate, then you have to calculate all the relevant ratios, solvency ratios, profitability ratios. Then you have to concern as much as possible all the ratios, market ratios, investors earning per share, dividend per share, then price earning ratio, all are very much important. Then if you go to the profitability ratios, then you can take net profit ratio, then gross profit ratio, then return on asset, return on equity, return on total assets. Likewise, you can calculate them, right? And also you have to interpret and compare with the previous years. I think it is easy to calculate, but it may, yes, you should be able to extract value from the financial statement, how to extract and how to add back or reduce some values to get real value for the for that type of ratios, right? Then liquidity ratios, and yeah, I am not going to discuss again. Previously we discussed. Now when you are discussing debt equity ratio, now this criteria benchmark is very much important, right? Then this ratio, if ratio is greater than 1, this ratio mean debt equity ratio. Then debt equal equity mean debt and equal debt, this value is 1 mean debt equal equity. If it is greater than 1, this mean higher geared, that mean loan or the debt are higher than the equity. If it is 1 even geared, that means equal uh, value for equity and debt. Then low geared mean, yes, higher value for equity and lower value for debt. Right. Now limitation of ratio analysis, it is also given, right? I'm not going to discuss in detail. Then you should be able to explain that limitations or the constraints of financial ratios too. Next is horizontal analysis compares financial information over time. It means that the horizontal analysis is performed by comparing financial data from a past statement. Vertical analysis is proportional analysis of each line item which is listed as a percentage of another line items in the same financial statement, right? Now that is the definition, one of the key definitions. Now you are asking, you ask to provide answers, discuss different types of horizontal and vertical analytical tools that can be used to analyze and compare the financial statement of the firm with their inherent merits and demerits. Then next, financial ratios are very powerful tools to perform some quick analysis of financial statement. Ratios can be utilized to calculate the relative size of one number in relations to another. Different types of accounting ratios are computed and used by different organizations for different purposes. So we can compare it to the same ratio calculated for a period of time, or period to period, or that is based on an industry average, to see if the company is performing in accordance with the expectation, right? That is again concept he given by this inverted comma. Explain the usefulness of different types of accounting ratios and also state the reasons for using ratios, right? You are given 10 marks for that. Then this is the descriptive questions. You can identify different types of ratios and their usefulness, then also the reason for using these financial ratios. This is regarding again credit analysis. Credit analysis is the method by which one calculate the credit worthiness of a business organization. In other words, it is the evaluation of the ability of a company to honor its financial obligations, discuss the general steps in the credit analysis process, and uses of credit analysis with the relevant reasons for using credit analysis. Describe the role of credit rating agencies in the business world and its usefulness for different business organization. Right, I think it is very much clear questions. There are number of internal and external factors responsible for corporate distress, and also different methods are available to predict the corporate distress. Then what are the discuss mean you have to explain about the different types of corporate distress models, right? Again, here you are given the comparative financial statement for 3 years. Here, balance sheets as well as the income statement. Then your task is to answer for this one. Prepare the common size financials. Is similar to previous one. Common size financial statement and liquidity ratios. You have to calculate liquidity ratios, solvency ratios, profitability ratios, activity ratios, market ratios, and you have to compare them. Next is this is regarding business valuation. This part was completed by Mr. Chaturaliyanage. Now you can see what are the factors which need to consider when valuing a business, and also you are given some details and asking about the calculation part, different valuation model. By using different valuation model, you have to answer for this question. Based on the above information, you are required to calculate the value of the business, right? Then there are a number of valuation method. Now you can use net assets model, or the price earning model as given by the instruction, right? You can list down the issues with dividend growth model, right? Again, similar type of questions here. Then you can provide answers for this type of questions, and this is regarding that merge and acquisition. Most probably you can see two questions, at least two questions from this area, this business valuation area, right? Business valuation and merge and acquisition. You can see two questions from this area, right? Now further you can see number of additional questions, right? Here additional questions and details. Here to calculate, you can practice. Yes, you can use this type of questions to provide answers. Now you can see 5 years details: revenue, cost of sales, gross profit, operating expenses, net profit, income from investment, finance cost, income before taxation, income after taxations, net profit available for equity shareholders. There are a number of important line items here, and also non-current assets and current assets, and then shareholders equity and long-term debt, and short-term liability, right? Now asking to prepare common size income statement and balance sheet, compute and interpret ratios relevant to the following categories. Now you can see categories: liquidity, solvency, same type of problem. You can practice them. If you practice them easily, you can provide answers for that. And also this experience is very much important to make decision in the practical scenario. Now you can see intrinsic value, and how to make decision when we know that intrinsic value and business valuation model, different business valuation approaches, dividend, discounted cash flow approaches. Now you can see dividend discounted approaches. Now there are a number of questions from here and also multiple choice questions you can see. Then your task is to read them and understand. In addition to that, some details given by the slides, objectives of financial statement and the limitations of financial statement. Previously we discussed them, right? Then this is the textbook for yes, already I submitted this book and content of that books and some other details you are given, that financial statement, and you can calculate their ratios, right? Then you can see the calculated ratios also. Calculated ratios also here. Current ratio, asset test ratio, the kick ratio. Then how to calculate them? What are the formulas here? Debt collection period and other details here. Return on assets, return on investment, return on common equity or the equity, operating performance, gross profit margin, operating profit margin, net profit margin, and asset utilization, cash turnover. You can see accounts receivable turnover, inventory turnover, working capital turnover, then here then plant property and equipment turnover. Then there are number of additional ratios also here. Then other descriptions on this credit analysis, how to uh, use these ratios to analyze this credit and liability, analyzing this credit and liabilities, right? Here, analyzing analysis of solvency, short-term and long-term solvency. Then again, you can use the same data now, profitability analysis. Yeah, by using the existing return on investment, you can return on equity. Then you can identify how to interpret that results and how to write this analysis, right? Here, valuation part also here by using ratios and cash flow analysis. Right. Now, additional then this is regarding the credit debt analysis or the credit analysis process. Here, this is the process. I think you already have done this one. Then what are the important steps of credit analysis process? Right. Then details are given. Right. Then you can refer that process. I think you have enough confidence about this course unit, right? Those are additional details. Yes, I asked about the debt rating organization, then Standards and Poor's, then Moody's Investor Service, then Pitch rating. That is the most famous one, Pitch rating. In our country, we can see some here pitch rating. Then here RAM rating. There are a number of organization here. Then next one is predicting corporate failure models, right? I think you are aware with that model. I'm not going to discuss in detail. Additional details here. This is Edward and uh, Altman. Altman Z score model, right? Then this is the details regarding them. Altman model. You can again you can read that book. Right. That's all. Yes. Then you can go to that book. This is the recommended book for you. You can read them. Further, you can understand your issues. You can you can see some details, credit analysis and other details, equity analysis, then business analysis, component of business analysis here. You can see the same structure. Then business environment and strategic analysis, then accounting analysis, then what are the differences between financial analysis and component of financial analysis, prospective analysis and valuation. You can see uh, details in details, then you can cover some details from here. Then you are given some in income statement and balance sheet, equity changes statement, and their common size financial statement, comparative financial statements, information here. You can see clearly understand the information given by the financial statement and annual reports. You can see management discussion and analysis, additional information in addition to the financial management reports, audit reports, explanatory notes, supplementary information, proxy statement. Further, we can see that good governance or the governance, corporate governance details, CSR details and projects, future plans, and all you can consider. Then analytical tools also here, and there are details. Common size financial statement, common size financial statement, and yeah, how to calculate common size. Then finally net sales or the revenue 100. Then out of 100, what is the ratio for cost of sales, gross profit, selling expenses, profit, operating profit, and net profit, net income. Likewise, you can calculate and you can compare in between years. This year this much gross profit is for 54%, previous year also 54, 55, 55 remain the same, no significant difference. Likewise, we can identify, then you should be able to compute that type of ratios and identify the differences, significant differences, and also you need to identify the reasons for that significant differences. Credit risk, right? Then calculations here, all calculations you can refer them. Equity valuation here, equity valuation, valuation models, and also in addition to that, you can use this book. This is also a very much important book. This is financial statement analysis and security valuation. Stephen Penman. This is also a good book. You can refer this book. This also has uh, very good content on this course units. This financial statement analysis and business valuation. Then I think you have enough time to refer them, and actually this content of this course unit is very much interesting among undergraduate and postgraduate students. They are facing for this type of questions very easily, and answer they are providing answers very well. Then I think this guide will be uh, provided that additional details for you. In addition to the guidance given by this LMS, then you can refer about this book. In addition to that, you can refer that best annual reports as I attach it to your uh, LMS. Then you can refer them and you can get idea about the content and important matters included in that type of financial sorry annual reports. That's all. Do you have any doubt or any things to discuss? Right? I think this is uh, the one of easiest and interesting subjects. Then you will face well. Then wish you all the best. Right? Okay.